Controlling interest and non-controlling interest. So let's get started. Controlling interest. Controlling interest in the company means when a single shareholder or a group of shareholders, single shareholder or group of shareholders who are acting collectively on a majority of voting shares more than 50% of a company, that is known as controlling interest. Simply, if we say that if a shareholder or group of shareholders more than if they are holding more than 50% of voting shares in the company is known as controlling interest. As you can see in this picture, this is the 100% share of the company, and in this picture this much group of shareholders are holding more than 50% of share, that is known as controlling interest. Okay, if a but there is one more thing. If a person or group of person who has less than 50% of ownership in the company, they can still have the controlling interest if a significant portion of the voting share is there with that person or the group of person. Okay, this is so because in many cases we have found that share doesn't carry the voting rights in the meetings of the shareholder. So if a shareholder or group of shareholders holding more than 50% of voting shares in a company is known as controlling interest, and they are also known as the majority shareholders. All right, let's understand it with the help of an example. See, Mr. X is holding 5100 shares in the company XYZ Limited. The outstanding shares of company XYZ Limited in the market is 10,000. Okay, now the question is whether Mr. X has controlling interest in the company XYZ. All shares have equal votes. Now, to understand this question, we should also know that what is the holding percentage of Mr. X. So first we will calculate the holding percentage. The formula for this is shares of Mr. X divided by the total shares of XYZ Limited into 100, because we are calculating in percentage. So the shares of Mr. X is 5100 divided by 10,000 into 100. So the shareholding of Mr. X is 51%. It means that Mr. X is having controlling interest in the company. Next we have non-controlling interest, which is also known as NCI or minority interest. Okay, this is just the opposite of controlling interest. It refers to the minority shareholders of a company who own less than 50% of overall share capital and therefore doesn't have control over the decision making process of the company. In controlling interest, the person or shareholder or a group of shareholders who have a majority of shares in the company, they have the right to control over the decision making process of the company. Minority shareholder doesn't have any control over the decision making process of the company. They cannot participate, they cannot take the decisions of the company. Okay, as you can see in this picture, the person who holds more than 50% shares, that is known as controlling interest, and this piece of pizza, the person who will get this comes under minority interest. It means suppose this is 75% shares and this group of shareholder or a person or one shareholder is holding less than 50% of shares in the company. This is known as minority interest or non-controlling interest. Okay, but generally in case of publicly traded companies, we have seen that mostly in the publicly traded company, mostly the shareholders are minority shareholders. Okay, they don't have any control over the decision making process of the company. Now in case of consolidation of accounts, the amount attributable to minority based on net asset value is shown separately as non-controlling interest in the balance sheet, reserve and surplus of the entity. Okay, now next we have types of non-controlling interest. There are two types of non-controlling interest. First one is direct NCI and second is indirect. So first we have direct. Direct means where the minority shareholders get their share in the recorded equity of the subsidiary. Here recorded equity means both pre and post acquisition amount. Okay, how I will tell you. Let's look at the example. Company B has reserved as on 31st March. 31st March is our books closing date. Okay, aggregating to rupees 5,50,000, and on 1st April 2019, Mr. X bought 10 shares of Company B. Since it is a case of direct non-controlling interest, Mr. X would be entitled to 10% of pre-existing and past profits of the company B in addition to the future profits accruing post 1st April 2019. Okay, now next we have indirect NCI. It is one where the minority shareholders receive a proportionate allocation of post acquisition profits only. So they will receive only the post acquisition, not pre acquisition profits. Okay, that is, he wouldn't receive a share in the pre existing profits of the company. Now look at the example. Company A holds 20% shares in company B, and company also required 60% shares of company B. See, if I draw like this, this is company A and this is company B. Okay, now company A holds 20% share of company B, and company A also requires 60% shares of company B. Okay, this is company B. Now which holds here means the company holds 70% shares of company B. So this company P holds 70% shares of company B. So thus, how is the shareholding of company P and B? Look at this. After that is post acquisition. Okay, now company P, shares held by company A. This is, okay, now this is 60%. This is the share held by company A in company P. This is 60%. Now when the majority of shares are with the company A, that means that the direct non-controlling interest is 40%. Okay, now company B, shares held by company A is 62%, direct non-controlling interest is 10%, and indirect non-controlling interest is 28%. How will we get the 28%? See, it is calculated using the direct interest on balance sheet of P Limited, that is 40% into 70%. See, here's P said that he holds 70% or 70% shares of company B. Now the 70%, here the direct non-controlling interest is 40%. So if you multiply 40% with the 70%, you will get indirect non-controlling interest. Okay, now next we have accounting for non-controlling interest on balance sheet. See, accounting means how will you show the non-controlling interest in the balance sheet. When it comes into the picture while consolidation of books of accounts. Now what is consolidation? Consolidation means a process in which the two or more companies are combined to form one set of financials. That is known as consolidation. It is applicable when an entity holds the majority stake in another, which is known as subsidiary entity. Okay, suppose if a company is having 75%, this is A company, he has 75% stake in B company. So it means this is a parent company or a holding company, you can say, and this is subsidiary company. Okay, this is holding company. All right. Now, as a consolidation combines two or more than two sets of financial statement, it allows the stakeholders. Who are the stakeholders? Investors, creditors, lenders who have invested their money in that company, to view the combined financial statement of all three entities as if that was one entity, to look that the company is, how is the financial position of the company. Now, while consolidating the financial statements of subsidiary company with the holding company, the net asset value of the shares held by minority shareholders is recognized as minority interest in the reserves and surplus in the consolidated financial statements. Now, look at this. See, this is the example. Company L is the parent company and company M is the subsidiary company. Now, company L acquired 85% of the shares outstanding of company M. So, it is parent company or a holding company. Company M is a subsidiary company. So, thus the remaining shares held by minority shareholders were 15%. So, it has 85% and this one has 15%. Okay. At the end of the year, company M reported revenues $5 lakh and expenses 3 lakh. So 5 lakh is the revenue, 3 lakh is the expense. So net income is 2 lakh. Okay. Now, whereas company L reported, company L means the parent company or a holding company. Revenues are $10 lakh and expenses are 4 lakh. So 10 lakh is the revenue, expenses is 4 lakh. So the net income of parent company is $6 lakh. Now, next is allocation of net income of company L. Company M is subsidiary, so we'll allocate the net income of company M between controlling and non-controlling interest. Okay. Now, 2 lakh is the net income of subsidiary company. Okay. And we know that 85% is the controlling interest of company L. Okay. So, 2 lakh into 85%, that is 1,70,000. So the rest part is the non-controlling interest of the company. Okay, now let's look at the consolidated net income. We know that revenues of parent company is 10 lakh minus expenses 4 lakh plus 2 lakh of, that is the subsidiary net income, that is income from the company M. Okay, so the consolidated net income is 8 lakh. Now net income to controlling interest. Okay, now 8 lakh is the total income. Now we have to, we didn't subtract from here the non-controlling interest, so we should get the net income to controlling interest. So this is the consolidated net income of parent company, that is 8 lakh. So we will deduct minus 30,000 from it, that is non-controlling interest. So 8 lakh minus 30,000 is 7,70,000. This is the net income to controlling interest. Now parent's net income, in the previous slide we have noticed that it is 6 lakh dollars. Net income of parent company is 6 lakh dollars, and the controlling interest of L company in subsidiary company is 1,70,000. Okay, so this is the parent's net income, that is 6 lakh, and controlling interest in the subsidiary company is 1,70,000. So this is the net income to controlling interest is 7,70,000. All right, now next is the balance sheet of Nestle company. Now I'll show you where we show the non-controlling interest. This is the balance sheet. Here the heading is liabilities and equity. Under this head, first we'll show the liabilities, that is current liabilities are there, then total of current liabilities, then we have non-current liabilities, then total of non-current liabilities. Then after current and non-current liabilities, we have the total of liabilities. Total of liabilities means current total of current liabilities plus non-current liabilities. Okay, after total liabilities we have equity capital. Okay, under equity capital, and under equity we have share capital, treasury shares, translation shares, other reserves, retained earnings, etc. So the total comes is total equity attributable to shareholders of the parent. Okay, after this equity heading we have non-controlling interest. Look at this, this is in red block, this is okay, this is non-controlling interest, and we add this non-controlling interest in total equity attributable to shareholders of the parent, then we get the total equity of the